Imagine waking up one day, looking at your bank account, and realizing you're richer than you ever thought possible. No lottery ticket, no risky crypto gamble, no selling feet pics online. Just boring, long-term investing. Yeah, the stuff your uncle talks about at family barbecues right before he falls asleep in a lawn chair. Today, I'm going to show you how regular people actually build wealth, slowly, steadily, and without needing a PhD in finance. And we'll do it with some laughs along the way, because if I just said compound interest and you didn't yawn, you're lying. When I first started investing, I wanted results in like a week. I thought I'd put in $500 and it would magically turn into a yacht. Spoiler alert, it didn't. Instead, my portfolio looked like my high school haircut, patchy, awkward, and slightly embarrassing. But years later, that boring, slow approach is what made the difference. Part 1. The magic of compounding. When I was a kid, I thought being rich meant having a Lamborghini. Now, I'm an adult, and I realize being rich means not having to check the price of guacamole at Chipotle. Compounding is basically your money-making little money babies, and then those babies grow up, get jobs, and start sending money back home. It's like running the world's nicest pyramid scheme, but legal. Let's say you invest $100 a month starting at 20 years old, with a modest 8% return. By age 60, you could have over $1 million. Wait until 30, you'll have about half that. Wait until 40, hope you like instant noodles for dinner in retirement. It's like planting a tree. The best time was 20 years ago. The second best time is today. The worst time? When you're already 80 and trying to climb it. If your grandparents had put $1,000 in the S&P 500 in 1980 and never touched it, it would be worth over $100,000 today. And that's without buying a single meme stock. Part 2. Why most people fail. Here's the problem. People treat investing like dating apps. Swipe left if the stock looks boring. Swipe right if it's shiny and exciting. But the truth is, boring is sexy in investing. Some of the biggest mistakes people make. Timing the market. That's like trying to catch a falling knife. Spoiler, you're going to lose fingers. Chasing hype. If your Uber driver and your grandma are talking about a stock, it's already too late. Panic selling. People see red in the market and sell faster than I do when someone asks if I want to go for a run. Humans hate losing money more than they love making it. That's why people bail out at the first dip, right before the market recovers and leaves them behind. During the 2008 crash, the market fell over 50%. If you sold in fear and stayed out, you missed one of the biggest rebounds in history. That's like leaving a party right before they bring out the cake. Part 3. The tools of long-term wealth. Think of index funds like a buffet. You don't need to pick the perfect dish. You just load up on everything. S&P 500 equals the 500 biggest companies. One share, and you own a piece of Apple, Amazon, Google, basically every company that steals your money every day. Dividend investing is the closest thing to a financial cheat code. You buy a stock, it pays you money just for existing. Imagine buying a pizza, and every year the pizza gives you a slice back. Infinite pizza, infinite money. Coca-Cola has been paying dividends for over 60 years. That means if you bought shares in the 70s, you've been sipping free Coke for decades, plus getting paid for it. Instead of stressing when to invest, you just put in the same amount every month. It's like setting your Netflix subscription, but instead of binge watching, you're binge growing wealth. Part 4. The psychology game. Long-term investing is like going to gym. The first month, you feel nothing. 6 months later, maybe you notice. 10 years later, suddenly you're a superhero. The key is patience, consistency, and ignoring people flexing on Instagram with their get-rich-quick nonsense. A few mental hacks. Zoom out. Stop checking your portfolio daily. Remember, recessions are sales, not the apocalypse. Stop comparing yourself to that one friend who bought Bitcoin in 2012. They also probably bought Beanie Babies in 1998. Markets go up, markets go down. But over time, they've always gone up. So when a market crashes, remember, you're not losing money, you're buying stocks on Black Friday. Part 5. What it actually looks like. Let's say you're 25. You invest $500 per month in index funds. By 65, you could be sitting on $2 to $3 million. That's millionaire status without inventing the next TikTok clone or selling your soul to hustle culture. Meanwhile, Chad, who bought Dogecoin because of meme, he's working double shifts at Starbucks. And that kind of wealth isn't just money for bills. That's money for choices. Work because you want to, not because you have to. Take random Tuesday vacations. Eat guac without guilt. Part 6. Call to action. The truth is, long-term investing isn't exciting day to day. But that's the point. Boring gets rich. Exciting usually gets broke. So if you want freedom, financial, personal, guacamole on everything freedom, this is the way. And here's the thing, nobody is going to do this for you. Not your boss, not the government, not your rich cousin who has a plan. Every single wealthy person you admire started by making a choice to put their money to work, even if it was just a little at first. The sooner you start, the sooner compounding becomes your silent business partner, working 24/7 without asking for vacations, coffee breaks, or a raise. So make today the day you plant your first financial seed. 10 years from now, you'll wish you started today. 20 years from now, you'll thank yourself. Your future self is waiting, and they're already rich.